Greetings, market rebels. Welcome to this week's macro measure. It is Sunday, October 15th, 2023, and it's about 10 minutes to 11 a.m. here on the East Coast. I'm Wayne, and we're going to get rolling along with our trusty disclaimer. And we're also going to get the trusty intellectual property rights notice out so everybody can memorize that for us, if you will. And then finally, we're going to get to this week's stream. Excuse me. Here it is. This week's stream that we'll be covering. And this is really a week where I wish we had a staff because this is really, honestly, one of the more memorable junctures that I can recall. And more importantly than that, this is a big deal in terms of what Tudor Jones and Jamie Dimon are seeing as well. So they're a little bit more well-known than I am. So I listen to them. Anyway, I think it's very concerning. And we're going to talk about all that kind of stuff. We're going to flash last week's stream just for memory. Some of this migrated over to this week's stream as it typically does. And then we try to keep updating and rolling along with the market, which is really a lot like our philosophy of trading, which is have your game plan in place, but be ready to adapt to changing conditions as best you can. And that's really, I think, if there is a holy grail I've ever come across, it's the willingness and the depth at which you can do that can really, really make the difference. I think being an adjuster, not an over adjuster, but a really good adjuster is such a critical thing. And a lot of people don't do that. A lot of people, it takes time, right? You've got to get time in, and it can be painful to go through that whole process to learn what to do. And a lot of people don't hack it long enough, unfortunately, for a variety of reasons, but sometimes they just suffer too many losses and before they get to that point. But I'm very confident that anybody that really applied themselves and learned all the different stuff you can learn and probably should learn can do this and do it well. It just takes a lot of effort and really kind of intensive application of what you learn, and then living through a lot of history. But that's this week's stream, so you should have had enough time to grab a snapshot, and you can pause otherwise. But what I'm going to do now is just reposition things for us, so please just bear with me, and I will move this off screen, and I believe we are going to be at the tabs check area. And I think I'll bring up this chart for starters and move us over to here. There's so much to talk about this week. I'm really struggling, honestly. I've been working on this for a while, and I don't even know what to say, because I think I could honestly talk for 3 hours about all the different things. And, considering I don't keep up on things as much as I'd like, that's kind of scary because of how much is really happening. I just don't have the time to do that, unfortunately. Between Ryan, myself, Greg, we probably all do get to everything, but it takes 3 people because of all the intensive stuff we do each and every day for the active trading services that we have to really keep tabs on. But let's go through things methodically as best we can. I'm going to talk about some of the review and summary. So we came into last week. We did note that the relief rally acrobatic team seized control of the market on Friday. We thought that it was still tricky, and we said keep your eyes on TNX and DXY. And I made a mistake, but that DEFCON 1.5 was 2.0 last week. Really, I would move it to 1.5 this week. I should have made that adjustment, but I apologize for that. But we did note that October was off to less than a stellar start because the first week was kind of rough, really save for what they did late last week. They did depart from the third year of the presidential cycle performance. And the charts, we had a little sort of smiley sun face there because the charts looked really good. Honestly, coming out of last week, the charts looked really good. And I think I said that if I were not knowing how Israel, Palestine, how that situation would impact completely. Normally, right, you see a down opening on something like that, and then usually they erase that, and they did. But you just never know, right? It's obviously there's so much that could happen given what's happened already. And so that was tough sort of curveball. And then, of course, you don't know with the bond market close what's going to happen on Monday. as well. So I just kind of said, look, if those two things are kind of neutral, right? We just say this is neutral. They don't impact things too much. We would say most of the time the market's a buy there because of all the technical work that we did, and I think that turned out to be the case just because you were so oversold in so many ways. And so they took that rally and they continued it really into midweek, even into Thursday morning. They were able to hold things up in the SPY, as you can see here. So that's very interesting. That pretty much came in line with what we thought. There were good looking charts. They did, I think, use those good technicals and that sort of counterintuitive, maybe this war is breaking out, maybe things get worse from here. And they did use that to mark stocks back up on Monday, Tuesday into Wednesday's opening, which was probably, I think Wednesday, no, it might have been Thursday's opening actually was the high for the week, but you get the idea that Wednesday, Wednesday and Thursday was kind of the turnaround point. And if you go and if you notice this DXY, you've just got to keep your eye on these things. I know it sounds like I'm super repetitive on this, but I think it matters because you'll see, I'm pretty sure that look what was happening with yields. And we thought yields were, the dollar end yields were due to come off. They'd gotten a little stretched, probably back off somewhat, we thought. And they did, the dollar did back off. And then you could see it moved back up. And of course, stocks went the other way. So this inverse relationship is pretty, it's not tick for tick, but it's pretty strong. And I think you should definitely keep your eyes on it, especially if you're new to all this stuff, and just keep your eyes on it and see how stocks trade. But you could see, right, yields were coming off. And then late in the week, we had this big reversal, right? This Thursday reversal, and they held things. So that kind of also played out a lot like we thought it probably would in most cases, where they were overdone. They did back up a little bit, but this late reversal, I wasn't expecting that to happen so quickly. And I thought there might be a little more dawdling, or at the very least, maybe a tiny bit more pullback, but it didn't happen. And that kind of is part of the concern for me right now, is that things that you would normally expect to happen were at least temporarily sidetracked or repositioned. And even the VIX, which has really been a frightened little mouse on Fridays most of this year, managed to sort of buck that trend for a change and really surged and hung in there. So this is probably one of your highest closes in months, except for maybe this one here, right on 10, like the week prior. So that to me tells me that, the market's taking risk a little more seriously than it had. I'll jump ahead a little bit here. And this, I think, is So I'm going to make a couple points here, and we'll talk about this more in sector situation. But a lot of things that we're trying just really fell apart too. Like there's your discretionary falling apart, right? So that to me is risk off, right? Here's transport's not a good sign to me that they're making new lows. If these things keep going, what does that tell you about the the movement of products through the economy, right? Right now, not a good sign. Industrials and basic materials also rolled over. But the most important thing, besides the fact that oil got back on its horse, energy sector was up, metals were up, things like that. The really kind of like hedges, right, if you will, and this is its own thing, but this could make matters worse for consumers, right, if things keep going there. So I don't think that's really good news in terms of, I wouldn't read it as this is good for the market. I'd read it more as this is not good for inflation and pressure that's on consumers, which is only worsening. And then your kind of resistant sectors, XLK, XLC, they finally came under pressure. And so you combine that with maybe you could say the SMH, which I think is one we've been keeping an eye on. We think it's very important. And that too had a really rough end to the week compared to how it was behaving beforehand. And so what's getting concerning to me right now is that you could have lower low here, this cluster low versus this low, lower high here versus this high. And then you might maybe have a lower high, right? So this could be a problem, and I think this is what I'm calling the danger zone on all the charts. So when you see danger zone on this week's stream on the slide, this is what I mean. If these lows get taken out, this is a big problem, I think, for bulls, and that you could be back down there testing that, right? If we have a rough week in the markets coming up now. So there's a lot to cover. So we need to keep going, but we'll come back to the charts for sure. We did say, now this is worth it because we may as well just make a few comments and then get to our tabs check. But so stocks were pressured, as we saw when the TNX and DXY started to stabilize and reverse. That's when stocks were under pressure again, which is what we've been keeping an eye on. So that's a tale of two moves, right? Early in the week, we had that nice positive action, but I would call it weak, which is why I'm talking about the outcome now on our slide. And the reason I'm calling it weak is because, right, bulls had their opportunity to attempt to close this gap right here, right? They were really within a stone's throw, and that would have gotten them to, I thought, an area that made sense if they did rally the past week, which was the 5,100 vicinity. And you can see that they did get into the gap a little bit, but they didn't close the gap. And I think that's maybe, right, a little bit of foreshadowing. We have to see, right? We have to see if it's just right back down again and you're back in the danger zone, or they put a higher low in. But that to me is a little concerning. I mean, I'm leaning more towards the way things unfolded. I'm leaning more towards that you might have a retest, right, of the danger zone. I don't know if it'll get all the way there this week. I don't know if it gets held nearby and slightly higher low gets put in. I don't know if a much higher low gets put in, right? But the other factor to me, technically, just in a very basic technical way, is this blue line. And you can see that light blue line, and that really comes from last year, right? I'll add a little more time, and you can see that that's right at the low that we saw really about a year ago, roughly, just a few days off. And then you've got this low near here, and I've got it drawn in with a little bit of a modification that I prefer, which to me just makes this action over here line up and become more concerning, where you were able to, right, if I take the line, I move it up a little bit like I did, then I have this high I have the high struggling there. I have this low right on it. I've got them trying to pop it through. I've got the open the one day on it. I've got them the inability to hold above there, even though it closed above there, and right back down and through. And so to me, that's concerning when the primary support line of this trend higher that we've seen really for about 1 year, we're now operating under that. And I know that seems like a minor thing maybe, but this has always been important to me. Something I noticed a long time ago. I don't think it's a great revelation, but you don't really want to see, if you're a bull, you really don't want to see us stay under here for too long. You're not going to be making any advances. And it's the kind of an early sign that you can't get back into trend, right? You're really struggling to get back into trend. And that's a problem, right? That if that trend gets lost, and what could be the start of us really knowing, yeah, that trend's cracked completely, it's being lost, is losing this low, which would really be right near that 200. We've been talking about that. We said a while ago that after it got below 430, I think we said like 432 was a big number for us because we've been using that over and over again. We had I think for the next one, I think down was like about 420. And now, right, you're right, pretty much. And then you had the 200 was lagging at that point, but now you've got the 200 right in this vicinity. So everything's sort of lining up, and this is a chance maybe to see what happens here. I would think, right, that a lot of this was built on these rate assumptions, and on our slide, what I've been mentioning for a while is that I think bulls are getting nervous. I think a lot of them jumped the gun, thought that we were in this new bull market. Maybe we are, right? Maybe this is just the test for this new bull market. I don't think so, but again, you just never know for sure. A lot can happen that's not in the technical analysis books and periodicals and all the stuff. People think that this must happen because this, and this, and it was put in a book. And I think a lot of times that stuff does hold up, but at the same time, there's unique situations, and it's a lot of this is the same thing over and over again. But then there are unique sort of standout situations, and to me, this could be one of them, just because things are the risks are just enormous right now, and I think right with rates the way they are, and the thing the rates being higher for longer than a lot of bulls assumed would be the case when they were buying, especially kind of in the latter stages of this, on the way to the high. I think that's the problem. Those people are got to be wondering if they were too far ahead of themselves. They should have been a little bit more patient. We'll find out. Maybe they were right. We'll find out. We just don't know yet. But if the 200 cracks, that's not a good sign. You all know that. Anyone that's been around for any length of time knows that the market cracking the 200 is not good. You have to realize that they do play a lot of games near the 200 as well. So again, that would really be in line with this. That would be in line with this particular, where's Market Rebellion? Right there. Yeah, that would be in line with this right here, which I covered on Cocktail. I've been talking about this, but you can see it doesn't even matter that we're in the third year of the presidential cycle, which happens to be the green line within like that lemon colored box right there. But you could see October's right here, and you could see that this is pretty volatile, right? And so is the lead. Really, you got a lot of up and down as well in November. So these are not docile months, especially October. And so the second half of October tends to be pretty poor as well. So you tend to kind of top out mid-October and then roll over overall. And so it's all about the degrees at that point of what year you're in. But even the third year doesn't really have a great look sort of from the midpoint on. It does make another lower, it goes a little bit lower. So I think that's what we're set to do right now. And that's and just a reason to be concerned. The good side of things is, and this is the paradoxical thing, is that if you look at some of the rates, right, here's the 30-year yield. We could just click on these, the 2-year yield. These all came off, right? They all backed up a little bit, just like we saw with TNX, right? The TNX is off from that most recent high. So that's a good sign. I don't think they've broken trend yet, which would be maybe nice, but maybe not nice. And that's what I'm getting at right now, which is that I don't have it exactly the way I want it, but I do have this. So this is all about what happens when the Fed cuts. What happens when the Fed cuts interest rates? And so this data was collected by Nick M., the chief operating officer for Ritholtz, graphed the performance of the S&P 1 year after each of the 29 Fed rate cuts from 94 to 2020. And he found that things held steady in the aftermath, but after a year, we're down approximately 10%. So overall, right, we end up with more corrective activity a year later. That looks a little bit like this, right, over time, which I was able to find based on that link in there. So you could see that just keep your eyes on the following the Fed cut, right, and how many sessions it is. So I'm not even saying that the Fed will cut. What I'm getting at is that when the Fed does cut, the following year is not very good, right? On balance, historically, you could see it just kind of gets worse the further out in time you go. So this is really at odds, right, with what we just saw. This is really at odds with here, right? This is at odds with what happens typically in your third and fourth year. So as per the presidential election cycle, Stock Traders Almanac data, we should really kind of find a tradable bottom here in about, I guess you would say, maybe like a month from now, maybe 5 weeks from now, somewhere near Thanksgiving. And then you tend to get this look at the rally you get in December virtually every year. I wonder why. But that's really what you should get. And then if you look at the fourth year, right, the election year, which we're coming up to, look how the market performs overall, right? You can see that it tends to be positive, right? So this, I believe that it's a 7% positive return on average in the fourth year. That's 7.3 is sticks out for some reason. I can't remember exactly why, but that's what I have stuck in my mind. I don't think I have that data right here, so I'm not going to worry about it. It's not that important at the moment, but that is at odds clearly with what we just saw. Excuse me. What we just saw with the rate cut, post rate cut performance. So there's a lot. I mean, this is a very hard juncture. So we don't need to belabor that, but what we can say is that things are shifting they shifted a little bit. So November's kind of held strong that we're not going to see anything. And I think that makes sense personally. I already said I think that this is a time where I think the Fed ought to I think there's enough economic seize up happening that they ought to chill out. But we'll see. We'll see what happens. Could be wrong about that. Doesn't really matter. They're not listening to me anyway. But this is still likely to see about 1 in 3 chance that you go a little bit higher by deck, but that's down, right? And then it's the same pretty much for Jan. And then you start to see where it starts flipping around, that people start thinking that we might even be dropping by March, right? So that's the tail there. That tells you pretty much what you need to know, that chances are we're not going higher as of right now. You know, the highest probability is we stay put for a while. Let's take a look at some quick sentiment stuff we usually check out. And this is also, to me, a little concerning because, again, this is contrarian. And this big bounce back that we saw this week from the AAII, that, right, optimism rises. So again, that could be that this market needs to sell off more to really pancake this. I'm not sure what drove that. It could be, right, that rates did back up a little bit and people saw that as positive. But as we saw historically, when the Fed starts cutting, right, if they're about to start doing that maybe in a few months, there's poor performance in the year that follows. And that's at odds with that fourth year of the cycle. We're not in extreme fear yet. We did back off, I think, from where we were. So you can see we're up near 35. It did get a little worse. So not a good sign there. And then we'll do our typical check here. You can see that this data, this tried to rally. It's kind of a strange way to state that, but you get the idea. Lower high, rolling back over, and that's the case. Now some of those things we said, they could get lower. They also, right, are near vicinity where there's rallies from. You rolled over naturally in the percent of stocks above the 50 SMA as well. And then finally, this one I think is the most interesting, though, is this MMTH, because we were saying that could definitely get, this is the one that has for a while has kind of held in there. So this could be, right, this could be what we need to see to really get a tradable low, is that we get a lot of stocks not far below. We get many stocks that drop below their 200 SMAs, and then that would really give you that super oversoldness, right, across the board. And you can see that really kind of bottomed just in front of the market right there, right? So that's, again, something that would be a good sign for a recovery trade, right? Or relief rally. We checked that out. This is what I wanted to mention while we're here, and then we'll get back to the charts. But if you didn't catch this, again, I don't think Tudor Jones is a dummy. And so I would say, look, it's what he outlined is kind of a lot like how I feel. I mean, I feel like it's very challenging right now. I really do. You can check that out on your own, of course, but I just wanted to say there's a couple notables, right? Jamie Dimon, most dangerous time in decades. So I think this is true. I mean, at least on what I know, and I don't just mean the geopolitical. I think it's just everything. It's just a mess. So many things are an absolute mess right now. And then this could become a mess, right? So these are what are referred to as warn notices, as per this WinSmart tweet. Worker adjustment and retraining notification by the Federal WARN Act, and then it mandates employers with 100 or more employees to provide 60 days of advance written notice of closing a plant, closing or mass layoff affecting 50 people or more. And you can see that this is moved. They said it advanced 2 months, so this is going to start impacting. And you can see that overall, the claims really do tend to follow along with this. So you could start to see that big spike. So that is concerning. I just want to cover that as well. And I think we've now have gotten to everything on the tabs. So we'll get back to the charts. But I just wanted to make sure you all saw those things, because to me, it's painting the picture that you could have a little bit more downside for sure. And I think the real key to this is that is the fact that this thing could not get back above trend. So you start to see I think this 430-150 level's been this right near here, anywhere between 430, 432 has been so big. I feel like I've been talking about it for a year and a half. I can't even remember, but it's just interesting. It just keeps showing up. But you lose that 150 there in rust colored, and that's about let's call it 428. That really opens the door. Sure, there's a flat line in here a little bit. You can see it 424.65, but that opens the door to me to the test of the 200, and you could be there. I mean, 1 or 2 rough sessions could even get you there, right? Might not even take all week. And so then, remember, this is what you have to keep in mind. If we arrive there in a super oversold state, because things have just gotten lamped, you've got to be careful with your entries, because these guys are the masters of false breakdowns and false breakouts. So you've always got to keep that in the back of your mind and be smart, which is why I advocate what I call the quick trim, where you just take 1 or 2 contracts. If you trade, let's say, a 10 lot, you take 1 or 2 of them, you put some money in your pocket, and that way, if it reverses back to your trigger level, you can get out of everything and reset and still eke out a small victory. And the psychological frustration isn't nearly as great as pulling a loss out of something that was once looking pretty good. So that's a nice little thing that I think helps people. But anyway, this is going to be the big test now, in my mind, if the scenario I think is most likely to happen this week, if that plays out. But what we should also look at, I think, is the fact that some of these companies that everyone's referring to now really as the Magnificent Seven, we look at all those together, they finally did come under pressure in a big way. So let's see if I've got them all there. I think I do. And so that was not a good close there right on Friday. And you could see that also failed to hold above what was the resistance line, made its way above there, but right back below, right? Once the momentum peaked and they rolled it over, it just didn't even respect it really. That should have been maybe a support line, just went right through it. And so now it's getting a little concerning that those may have trouble. Now, of course, earnings are coming up, and so that could be problematic, but there's another line I would drop in there, and you could drop below that. That would put it below this little short-term trend. You'd be falling below there, but your 100 is probably your big number here on this. If you want to chart this, I know probably a lot of people don't, but 17, let's call it 1753. So if that whole package of the Magnificent Seven is below 1753, that to me is a problem. There's a lot of air. There's not a lot of support once they crack below some of these lows here. This thing could really, and you can see the gaps galore that are in this thing. So not really a great sign in my book that they're rolling those things over. It's still fine at the moment, in my opinion. It is still, let me see if I get this to work over here. My bad. There it goes. It's still okay, but it's not over for this, but my stuff says it's getting a little dangerous in here, right? A little bit. And I think that's going to be when it gets considerably more dangerous is near that 1750, 1753 area. So just you might want to keep your eye on those. Unsurprisingly, right, XLK, which is more sector situation stuff, but XLK, this also again looks similar. You can see that, and then XLC looked a little bit worse, in my opinion. The way that it just fell off a couple of rough days there. And that also, these are all the danger zones in some of these things. They're not too far away. And so this is not looking good. The good thing for bulls is there's a lot of SMA support potentially there. So it might not completely crack. It might hold. Maybe they pull that off again. Maybe you hold again. This 100 has been a big deal, though. You can see that there's really 3 or 4 sessions in a row where the 100 seem to matter, the proximity to it. Another 3 or 4 sessions in a row where it seemed to matter. So again, this would maybe be the 3rd time down and testing it. And that's not something you really want to see if you're a bull. And again, another thing that's important to the market, it's been a leader, just like XLK, and it's got gaps galore. And if they decide to do a test of the 200, right, that is that 10% further from here, roughly speaking, that we could get down. Get down to SMH, another major leader. Right there, right? That is something we already talked about a little bit, but you can see the lower high maybe there with lower lows like we talked about. So gap, course gap. This is also a problem. So knowing that the second half of October tends to be rough, doesn't have to be. It just historically is. All these other situations, right? With if oil keeps rising, that kind of stuff, right? These layoffs keep jumping, and then people think it's going to be wonderful that the Fed starts cutting, but we could see that that's historically not the case. So this is why there's a lot of reasons why, especially with the cycles at odds with the performance after rate cuts, that's concerning, right? It's very interesting in a way, but also very concerning. And you can see here's your XAU, and I have not been a bull on this, right? I put some bullish ideas in, but I kept looking at some of the bigger picture stuff here that I just haven't liked it. But I have to say, right, this is maybe the kind of thing that could really change the fortunes. Unfortunately, these awful developments in the world could change the fortunes of that sector, right? Much like we were saying that you would expect them to have some kind of a bid on that news that broke late last week in the Middle East. Same thing with XLE, which pretty much they both did the same, right? And the dollar, this usually XAU, normally with the gold, silver, you see a pretty good inverse correlation with the dollar overall, but you can see both sectors moved up as you would expect, right? We were kind of saying probably they gap these things up, and then we'll see what happens, how powerful things get from there, or if they fade. And they hung in there, and this even hung in there, started backing off right when the dollar turned, but then by the time Friday rolled around and that traded, I guess the weekend had people concerned. So this is what I mean on the slide when I say that the market's kind of confirming that risks are building, market technicals, because this is the sector that a lot of people are going to hedge in. Oil's obviously concerned. The VIX, as we saw, the VIX screamed higher and held on a Friday. So you have a lot of things that were telling you that this is a little bit different, right? So I think you've got to be a little more, that's why I took us really to DEFCON 1.5 from 2.0 last week. I just didn't do a good job of noting that on the slide at the proper place. I was going to re-note that, but I just didn't get to it. So as far as the current assessment goes, we did cover all the tabs. It's an indecisive time, like I said, chock full of risks which are building. I think the market technicals confirm that. We talked about the relief rally and when it ran out of gas. We said that the script really flipped between the first week and second week in OCT. We did get that sort of rally early in the week. That was supposed to come really in week 1. So we have a little bit of a flip from week 1 to week 2. But effectively, the action did what we would expect, just not in the right order as per the cycle information we've been working with. Late October tends to be not a good period, not a good phase, as we saw. And so I think that we're seeing concerning surges in these sectors like XAU, something like the VIX, and some of those leaderships names that we saw in the Magnificent Seven, the XLK, XLC, they're losing their luster, right? SMH, they got a little more concerning. I think if you're just taking that snapshot in time, these things became a little more concerning. They're not absolutely doomed, all the things I've just mentioned. I don't think they're doomed right at the moment, but that's not a good turn of events as what we saw on Friday with maybe a lower high put in, things like that. So it's early, and that's why I'm saying it's indecisive, but it's growing. And I think there would really need to be some positive developments in yields or just news overall to really jack this thing back up and have it break out. Now that could happen. I mean, we could see a development like that. But again, that's why I'm saying it's sort of an indecisive time, because without that, though, without something happening, riding to the rescue of this market, I think the market took a rough turn for the worse, and it's set to maybe get a little bit more worse as per history. So you've got to really be careful at this point with those leadership sectors losing their luster and the big Magnificent Seven maybe doing the same. Just be careful. I think the bottom line for this upcoming week is I would expect volatility to persist. We've been saying that since the end of SEP that ACK and NOVE tend to be volatile, especially ACK. And so you've got to be on guard. It has been. It really has been. So maybe what we need to see is one more sell-off and we get a real test. And then maybe there's a chance at a little bit of a bottom late in the month, and then maybe stabilize, and then maybe get your end of year rally. I would hope that we do that. But again, with all these things floating around out there, there's so many really concerning moving parts out there around the world. I think it's going to be tough. It's going to be really tough. And I just don't buy. I mean, I think the Tudor Jones stuff just proves that, our take has not been poorly founded, right? The concerning take we've had now throughout the entire rally. We trade the rally, and it was good to us. We traded the rally, it was good to us, but again, you've got to do this within context. So I don't know. I don't think it was good to convince yourself that it was the be-all end-all start of a new great bull yet. I mean, it may be. I hope it is. I don't see it that way. I just don't see what I'd like to see from things. So I remain unconvinced, or not persuaded, would be another way to put it. So I still think there could be more corrective action on the way. The good news would be, though, that if folks get worried, they start buying bonds, which they may have done because they want that flight to safety, that maybe, right, that does bring yields down, and that does help the situation that yields are going to maybe stabilize and not continue to power. But if that just keeps rolling, that's a problem. I did hear or see something, I think, where I believe the shorts in treasuries have reached an all-time high. So that's good in a way that, if bonds start to scream back up, there could be a real move, right? So we'll see how TLT looks on the charts, as a matter of fact, now that we're talking about that. And, you can see that's been pretty bad. The last couple of days, you can see that sort of like buy bonds, right? Buy kind of flight to safety type trade. And then that started running out of gas there on Friday. Maybe it was Thursday, but they held in there really on Friday. So overall, that could maybe happen, but you can see the trend's been awful, and obviously that's why yields are going up. So I think this was just a week, again, kind of finalizing things here. I think it was a weak rally attempt. I mean, it was in a way, it was impressive that they moved it up as much as they did, but if the bulls were really more assertive and really believed in things, I think that they would have been able to close this and at least get up towards that 50 and 100, and they weren't. Maybe it's still to come, right? Maybe you get hold here at the 150 or nearby there. Maybe they put another leg of this rally together. I'm leaning the other way right now in terms of my expectations. I think you could just, if you crack this 150 and yields are heading up, I would think you probably just go back down, right? If they're moving these yields up towards the recent highs, and this 150 gets cracked here and rust at 428. To me, you're on your way down. You're on your way lower. That's how I would read it as of right now. And anything really in between there, right? You just got to wait and see. Wait and see, because if they hold here, we always have to think a couple moves ahead. If they hold above here, they're going to have a higher low put in that maybe opens up the door to them trying to work it even higher. You just don't know, and you have to watch for the developments in the markets. And again, that's where the dollar, the yields, you just got to keep your eyes on it. So I am concerned though at the moment. This snapshot in time, I think you have to be concerned with the way that the market finished the week. Some of the leadership names that came under pressure and a little more weakness here, right? All you need to do is sell off for less than 1% more. And this thing, I think, is opening the door to another maybe 1 to 2% lower. That would be enough, like test time. It would just be test time. So I think I can't buy what the perma bulls are selling. I already mentioned that. I still can't buy it. I still hope to be wrong. I think the Tudor Jones Diamond comments sort of back up why we've been reluctant to just embrace the market for the whole time, right? Just don't believe it. But you got to, in the short-term trading especially, you just got to go with the momentum, and that's what we always seek to do. And sometimes we just have a more confident lean, and sometimes, right, we're more just open to dual-sided action that we are willing to just jump on and try to do the best we can with it, and not get too locked into some kind of a mindset that prevents us from capturing profits in the short run, right? That's what we're trying to do with most of the services. So again, final thing I would mention is I do think that you got to be worried if you're a bull that went in as a true believer with the way these economic statistics are shaping up still, the activity shaping up, what these higher interest rates are doing, what's happening to the job market, all the problems that are out there, the rising costs, all of it. I think you have to be anxious. You have to be nervous. I'm not so sure you can act as though everything's wonderful the way you thought it would be. I can't believe that if you were buying up in here, you really thought that all these problems were going to develop and you weren't going to have to worry about them anyway, because ultimately everything will be fine. If you're that good, then I wish I could get dialed into where your crystal ball is and what it says. But I don't think a lot of the stuff that they were spewing back here has held up. And I think you've got to be worried when you start breaking below that blue line, that trend line, and now getting rejected from really getting back in and holding above it. Could change Monday, right? It could change on Monday, but as of right now, I just don't like the way that looks, and I don't like the action overall. What I would say is that you should, at the very least, know the collar, right? Know the collar strategy. If you're new to this stuff and you recently joined Market Rebellion, I can't think of a better place to learn from than Market Rebellion in terms of Bill Johnson and the coaches. We've always had, way back when, for over the years, we've always had different names for the company, but we've always had really, I think, excellent educational content in terms of helping regular folks learn on the level of a professional options trader. And Bill Johnson does a tremendous job, in my opinion, on all the stuff that he touches. Really, he's the main guy when it comes to the education. And I've been friends and partners with Bill for a long time. We got together, it's been about 15 or 16 years ago. But yeah, he does a tremendous job, and you can probably get into a Q&A session and if you're in a certain service, and you can get some great answers from Bill, or show up on Coach's Corner when Bill and Stu do that. They do, I think, a weekly Coach's Corner video somewhere, maybe on YouTube. I think it's live that you can attend that. But the collar strategy to me is a must. If you get concerned, the ability to really protect yourself without having to put any real serious capital out to do so when you're concerned is I just think it's just a huge thing that you can do. And I think you really you ought to know that at the least in terms of protective strategies. So that's what I would encourage everyone to do, especially if you're new and you haven't seen this before. It's not complicated, and Bill Johnson, I'm sure, would give you a tremendous explanation every which way to Sunday with regards to the collar. So I think you got to be careful. To kind of sort of summarize here, I think you have to be really careful. We saw how a lot of things did not act well at the end of the week. We saw all that stuff, and we saw how these risks are really building. We saw the aftermath of when the market, how the market performs once the Fed reverses course, and maybe that happens sooner than later when they realize that they've probably over tightened, from what I can tell. But that's also what they typically do, and that's why we have the problems that we do. Well, some of the reasons anyway. But on that note, I'm going to thank everyone for tuning in. I hope something I shared with you helps you out this week or some week in the future. And I'll see everybody through the webinars and newsletters and updates and cocktail hour this upcoming week. Have a great conclusion to your weekend, and get ready for probably a very interesting week and second half of October. Thanks again.